Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt. I look at the week's financial news that can be a bit confusing, misleading, and take, of course, out to make it actionable, understandable, and clear. What a week, what a show. 3 good ones. One of our regulars is on here, which you'll be glad to see. We're going to be looking at when chasing more dividends leaves you with less. We'll do some definitional work to make sure we're on the same page. This is Mr. Jason Zweig, one of our favorites. We'll then be looking at an article I got from a law firm about the Securities and Exchange Commission charging Mr. James O. Ward. He's an Alabama resident from, I believe it's Foley, Alabama. I don't think I've ever been to Foley, Alabama. But we talk about his defrauding of investors, how he did it, why we need to be aware of folks like that, and what we can do to protect ourselves. And then in close, we're going to look at a guide to why you should buy bonds and why you shouldn't by John Sindrew. I think it's always an interesting time to ask ourselves the tough questions like, do I need more bonds? Do I need any bonds at all? We'll look at it. At the top, when chasing more dividends leaves you with less. Subheadline, high yield equity funds are popular, but the pursuit of a large payout can sink your portfolio. Bum, bum, bum. Well, let's do that definitional work. What's a dividend? I know so many of you are just these experts, but I think even the experts need a reminder. A dividend is a payment from a company that they make. It's usually a cash payment. There have been some unique circumstances where it's paid out in shares, but usually a cash payment in America, usually quarterly and usually fixed. So if you have a stock that, for example, trades for $10, and it has a dividend across the entire year of $1, it's a 10% dividend yield. Even though quarterly, of course, you're going to get paid one quarter, but for the year, that's an annualized figure. That's how you get that dividend yield. Okay? So, and that bond yield figure, same sort of math. So, why does this matter? Now, dividends have always been one of those things that investors have gravitated to, especially in lower rate environments. Zweig is alerting us to this. He says, we have a rate cut coming, it appears, from the Federal Reserve. Zweig says, if the Federal Reserve cuts interest rates this month, that will benefit borrowers and hurt savers. You understand why? The lower the rate you're going to get on your investments. Because if you have money on deposit at the bank and the Federal Reserve lowers the rate, you'll get a lower yield. For a borrower, it should result in lower rates for you. So what Zweig says is that makes high dividend funds hot. So if the market thinks that rates are going lower, they are going to rotate into higher dividend funds so they can get that yield. So they're estimating in this rotation that exchange-traded funds specializing in dividend-paying stocks took in $4.5 billion in new money in July and August. That was estimates from Mr. Ryan Isaacson, a strategy at First Trust, an ETF manager in Wheaton, Illinois. So, what Zweig is also highlighting is, okay, that it may sound safe. These high yield, high dividend funds, they may sound like, there's safety there. There's a sense where that can be true. So you just got to drill down and look a layer deeper than the veneer. He gives an example that I think is worthy of repeating to you. He's talking about the downside of chasing these high yield funds, and he gives an example of the Global X Super Dividend. This is an ETF with, brace yourselves, $784 million. That's a lot. It yields 11%. So you remember my example where you had a $10 stock and it paid out $1 a year, and therefore you had a 10% dividend yield. This Global X Super Dividend at 11% is just above that. So if you put $10 in, you're getting a little touch over $1 every year. Now, that's big because you can compare it to 1.3% on the S&P 500 for the dividend yield, 2.1% on the Dow Jones Industrial Average, and 5% on short-term U.S. Treasuries. So here we go. Here's where you got to make sure you're sitting down because this is going to hurt. The Super Dividend Fund's supersized yield came at a cost, said Zweig, launched in June of 2011 at $75. This week, the shares traded around $22. That's a 70% decline. If you'd bought the ETF at its inception and held continuously to the end of August, you'd have lost 9% after accounting for all those jumbo dividends along the way. Now, catch this. This fund, it actually outperformed its own benchmark of high-yielding companies. But, of course, it lagged behind kind of global small and mid-sized stocks. Yeah. So what happened? Well, it's such an aggressive dividend payout. It starves these companies, and they're not unable to do a whole lot. And you're effectively eating away at the capital of these companies. These are companies that the Global X Super Dividend Fund buys 100 of the highest yielding stocks worldwide. It buys stocks that yield no less than 6%, no more than 20%. It then culls them quarterly to exclude those that have cut their payout or have a negative outlook on dividends. So you're just jumping into ultimately garbage. Now, I think there are a lot of other ways to create income, and at the end of this article, Zweig highlights that. But just know, I mentioned this in my last podcast, you and I are susceptible to this. We can back into these sorts of investments. It is so easy logically to convince ourselves, especially when you're desperate for yield, that this is a fine investment. Always be suspicious when a click of the button can make you a lot more money. Just be suspicious of that. If there's no extra effort or energy or research required, you just click a button and you're going to go from a 1.3 dividend yield on the S&P 500 to an 11% dividend yield on the Global X Super Dividend. Something's up there. The market's not that dumb, so you're taking some sort of risk, and it turns out you did. You did. These companies are high risk. There's no doubt. The market, when it assigns a dividend yield that's really high, it usually means, one, it doesn't believe it's sustainable. So if you look at someone with a 20% dividend yield, that's wild. The market is saying, we don't think you can keep paying that. And usually the market's right. So I followed some of these companies who I thought, I've done phantom trades. As you know, I'm an index fund investor, but for fun, I will place a trade in my head and on paper and see how good of a stock picker I would be. Turns out not that great. But I looked at AT&T a while back prior to their dividend cut, and I thought, wow, this AT&T, like the yield was huge. And what the market was saying is, hey, there's going to be a dividend yield cut. The CEO had not said that. The market had said that because the market was implying at this high yield, it's unsustainable. The market was right. CEO comes back later and says, yeah, we're cutting the dividend. So the market's pretty good. It kind of knows what's around the corner. Not always, of course. Not always. But anytime you see a big old dividend yield, 99.9% of the time, there's a really good reason why the market is assigning high yield to that, and you should be very careful. The old phrase, more money has been lost chasing yield than at the end of a gun, and I've given that on this podcast previously. The point being, at the end of a gun, meaning via theft, it is just a huge human temptation, and it's going to come back to us. So if rates do, in fact, go much lower, you're going to have the same temptations. You're going to look at your bank account and say, what am I doing? I'm earning 0 or 1%. Why am I doing this? Let me go take on a little more risk. Be wary. Zweig's kind of application here is steer clear of dividend funds paying more than 4%. I actually agree with him on this. He says if you want a high yield, one possibility is to create your own out of a generic stock fund that isn't even focused on dividends. Sell a portion of your holdings each month in amounts that will generate the income you seek, and that should be taxable at low long-term capital gains rates. I call this synthetic yield. I don't know if that's the right term. We coin phrases here at the Robert Hunt Financial Market Update all the time. All the time we're coining phrases. Are other podcasts doing that? I don't think so. But we call that synthetic yield. I like it a ton more. One, you don't have to find this diamond in the rough high dividend yield fund that hopefully will last, hopefully won't. And then it's more tax efficient. So you're typically going to have more efficiency. Just own an index fund, selling it if you need that yield. Just keep it simple. Don't try to chase these dividends. It ain't going in well. And then our court case, or our SEC case, I got this in the mail and had to share it because I don't think we can talk about this stuff enough. Securities and Exchange Commission today charged James O. Ward, Foley, Alabama resident, with defrauding investors. He made misrepresentations. His investment firm, Apex Financial Institute, I'm waiting for one of these names to be like Dog Excrement Investments, Inc. Just some terrible name. That'd be more appropriate. But they always have good names, so you've got to be wise. The names always sound good, guys. Apex Financial Institute. Private investment fund managed by Ward and his partners that raised at least $852,000 of crypto assets from approximately 70 investors in the U.S. and abroad. 70, guys. Picture those people in a room. 70. That's a lot. According to the SEC's complaint, in March and April 2021, Ward live streamed several Apex investor presentations and then posted the videos on YouTube. Live stream, for those who aren't familiar, means he's literally filming himself. People can join in to YouTube and watch live. He then records those and keeps them on YouTube. In those videos, the SEC alleges Ward promoted Apex as a hedge fund, falsely claimed, among other things, that Apex was regulated by the SEC, had $25 million in assets under management, had successfully conducted a 12-month beta test of its strategies, employed trading strategies that offered investors the opportunity to experience substantial gains without any risk of loss, and had several international offices. If you're going to lie, go big. I guess that's their thinking. The SEC alleges that in reality, this is why it's better to be rather than to seem, Apex was never an SEC-regulated entity. It did not exist prior to February 2021, had no assets under management prior to taking on investor funds, and never had $25 million in assets under management. I suspect they also did not have international offices. Oh, yes, guess what? They did not. It was a bunch of dudes on computers in their homes, or as Charles Barkley probably would say, in their grandma's basement. That's what Barkley, that's how he disparages folks of this kind. So, no offices, operated from Ward and his partner's home computers. So, in the Southern District in Mobile, he violated all these various SEC rules, yada, yada, yada. As an investor, I think what's more interesting is not, oh, look at these people, how could they fall for this? What a foolish thing. What I think is more interesting is how can we humble ourselves and realize we are capable of falling for something like this? And what are the patterns of successful frauds like this? Well, he established credibility through a lot of lies. I mean, he went for broke on the lies, but it should remind all of us we need to trust but verify with everything. My experience swimming in the waters is that very few will actually verify, and we're more prone to trust. It's a lot of work to verify. It's a headache. You're known as a difficult person. You want to fit in and feel the rush that comes from putting money to work and something you think that will help you. And so someone comes on and says they're regulated by the SEC. That is one click on a computer to find that out. $25 million in assets under management. That's a couple clicks, maybe a phone call. The 12-month beta test is also a phone call. Show me the spreadsheet. And then this is what should have, for all of us, under no circumstance, when someone says that they purported that there were substantial gains without any risk of loss, you've got to leave the room right then. You actually cannot stay a moment longer when someone tells you you have gain and you have no extra risk. One of two things are true. The person telling you that is dense or they're lying. In either case, you don't want to partner with them. Now, it's usually not said with as much candor as this SEC allegation stipulates. What is usually implied is that it's a low or no risk and when you have substantial gains. That's how it's usually implied. So you'll go to a seminar, auditorium, here comes the investment pitch. Hey, this is almost a no risk deal and you'll earn double what you'd make in the bond market. It will sound something like that. Anytime someone tries to downplay risk too much and inflate upside too much, look for the exit sign, particularly if it's this brazen. So that tickles the investor's ears. That can tickle our ears. Oh, great. Less risk, more reward. Sign me up. And it's just a confusing enough strategy where you're somehow doing some gobbledygook trading crypto. And this trading strategy was back tested. Even if they showed me a back tested strategy that had worked for 100 out of 100 years, I still wouldn't have a ton of confidence. I don't know. I mean, it's crypto, so it's brand new, but I don't know that it's a trading strategy. That means it's short term. That means they're in violation of the RHF market update edicts of keeping your time horizon long. No such long time horizon here. So that punts us out of that one. So you may not, listener, be subjected to a lot of these sorts of pitches, but if you're just subjected to one or two or three in your life, being able to repel them may be one of the most profitable things you ever do. Because, as I said previously, more money has been lost chasing Yuli at the end of a gun. And don't think any of us are any better than these 70 people. These 70 people probably heard return expectations that were eye-watering, maybe needed the money quickly and to catch back up, and so they fell prey to it. And then a brief sermonette on bonds by Mr. John Sindrew, a guide to why you should buy and shouldn't buy bonds. Bonds have regained the haven property that made them desirable for 60-40 portfolios, but other factors matter more. I think this is just important to say. The 60-40 stock bond mix is this famous portfolio. I thought this article was interesting. There's an economist, Harry Markowitz. He mathematically made the case that diversification improves risk-adjusted returns. That was just in the 1950s. You realize how fresh some of this financial theory is that we now see as bedrock, and it is. But that just shows you how much progress we have made. So this article explains the 60-40, that's 60% stocks, 40% bonds mix has delivered negative total returns only 23% of the years between 1872 and 2023, compared with 27% of the years for the S&P 500. So what it did is it shortened lengthy stretches of negative returns. And this is data collected by Robert Schiller at Yale University, who's a famous professor that I suppose could not get tenure at Texas A&M. You never know why people don't do it, but I guess, whatever. The point, listener, is that there are going to be seasons, and that season could be now, it could not be, where there are going to be investors who are a strong candidate for bonds who are going to overlook fixed income because equities, stocks have been so good. Beware, there are decade-long periods where the bond investor has done better than stocks. In fact, the return expectations currently that Vanguard has out from their capital markets group, which I've read before, show that bonds have a higher expected return over the 10-year period than U.S. stocks. U.S. bonds over the next 10 years have a higher expected return than U.S. stocks. Now, who knows if that's worth anything? It should just raise your eyebrows to say, I don't know. Now, all this is specific to your situation, where you are, but be willing to talk with your advisor about, do I have the right amount of bonds? Do I not have the right amount of bonds? What I'm seeing is people are just pedal to the metal, all equities. There are a couple instances where that's appropriate, but for most humans, that's more than they can stomach. And let us remember what we should stomach each day, which is to keep those costs low, that investing symbol, and that time horizon long, big as that's what's going to give you the best shot on your investing journey. Until next time.